For years, silver existed in a strange contradiction. It was everywhere and nowhere at the same time. It ran through smartphones, solar panels, medical equipment, electrical grids, and defense systems, yet its price barely reflected that importance. While food, housing, energy, and everyday necessities climbed relentlessly, silver seemed trapped in a narrow range, rising briefly before being pushed back down. To most people trying to protect their savings from inflation, it felt as though the metal designed by history to expose monetary excess had been silenced. Behind the scenes, a trade grew so large that it relied on silence to survive. Major financial institutions built enormous short positions in silver, not measured in ounces anyone could hold, but in paper promises stacked on top of one another. Futures contracts, swaps, and derivatives multiplied exposure far beyond the amount of physical metal available. As long as confidence held and prices stayed contained, the trade worked. Losses could be rolled forward, contracts could be cash settled, and the appearance of supply could be manufactured with keystrokes. For everyday investors watching their purchasing power erode, the message from the financial establishment was consistent. Silver was volatile. Silver was outdated. Silver was a distraction. Inflation could be managed, they were told, and sophisticated institutions had it under control. Physical metal was unnecessary when modern finance offered efficiency and liquidity. Yet inflation did not behave as promised. It lingered. It spread. It embedded itself into wages, rents, insurance, and interest rates. At the same time, industrial demand for silver increased steadily. The energy transition required it. Technology required it. Mine supply failed to keep pace, and above-ground inventories quietly thinned. None of this showed up clearly in the price. The disconnect grew harder to ignore. The short position grew alongside it. What began as a strategy became a dependency. Large players could not easily exit without moving the market against themselves. The trade required calm conditions, predictable ranges, and confidence that any upward move could be fated with additional paper selling. For years, that assumption held. Then conditions changed. As inflation expectations hardened, more individuals stepped outside the paper system altogether. Coins and bars moved off dealer shelves faster than they could be replaced. Delivery delays lengthened. Premiums over spot prices widened, signaling stress beneath the surface. At the same time, silver futures began to climb. Not explosively at first, but persistently enough to pressure short sellers. Losses accumulated quietly, then all at once. When prices moved beyond key thresholds, margin requirements rose. Brokers demanded additional collateral to maintain positions. What had once been manageable on paper became urgent in real time. Some institutions added capital, others hesitated. Some were unable to respond quickly enough. That hesitation proved costly. Forced covering began when positions could no longer be maintained. Shorts became buyers, not by choice but by obligation. Each buy order pushed prices higher, increasing losses for those still trapped. Margin calls multiplied. Liquidity thinned as volatility surged. The market moved faster than models predicted. Reports emerged that billions of dollars in short exposure were being unwound in a compressed period. What had been framed as routine market activity suddenly demanded explanation. Trading volumes spiked. Price action grew erratic. Analysts who once dismissed silver as irrelevant began speaking cautiously about positioning risk and market structure. As the unwind continued, The contrast between paper silver and physical silver became impossible to ignore. Futures prices fluctuated wildly, yet physical metal grew harder to source. Dealers raised premiums. Inventories tightened further. The promise that paper claims were interchangeable with real metal looked increasingly fragile. For institutions caught on the wrong side of the trade, the problem was not simply loss, it was exposure. The mechanics of the collapse revealed how much leverage had accumulated and how few participants controlled a disproportionate share of the market. What had been described as liquidity now resembled concentration. For those who had held physical silver through years of discouragement, the moment felt different. It was not vindication in the sense of triumph, but confirmation. Confirmation that prices can be managed for long periods, but not indefinitely. Confirmation that fundamentals can be deferred, but not erased. Financial media began adjusting its tone. Coverage shifted from dismissal to curiosity, then to concern. The story was no longer just about price movement, but about structure. How many contracts existed for each ounce of deliverable silver? How resilient was the system if more participants demanded settlement rather than cash substitution? These questions had been raised before, but rarely with urgency. The institutions involved offered reassurance. The market was functioning, they said. Volatility was normal. Losses were contained. Yet actions spoke louder than statements. Positions were reduced. Risk limits tightened. Exposure was quietly shifted elsewhere. History suggested this pattern was familiar. Whenever leverage overwhelms reality, markets eventually correct the imbalance. Similar episodes had unfolded before, each time revealing how incentives shape behavior and how narratives protect those who benefit most from the system as it exists. What made this moment distinct was timing. It unfolded against a backdrop of widespread distrust in monetary policy and growing awareness of inflation's permanence. Silver was no longer just a commodity trade. It had become a referendum on confidence. Confidence in currencies, confidence in institutions, confidence in price discovery itself. The collapse of the massive short position did not end these questions. It intensified them. If silver could be restrained for so long despite rising demand and monetary instability, what else was being mispriced? And if that restraint could fail so suddenly, what other trades depended on similar assumptions? No market remains free forever once it demonstrates the ability to break containment. Behavior changes. Shorts become cautious. Longs become patient. Physical ownership gains relevance again, not as speculation but as insurance. For everyday investors, the lesson was not that silver would only rise from here. Markets do not move in straight lines. The lesson was structural. Understanding how leverage concentrates risk, how paper claims differ from tangible assets, and how forced unwinds accelerate price movement offers clarity that extends beyond silver itself. The trade that collapsed was never meant to be seen. It relied on complexity and complacency to remain invisible. When it failed, it revealed more than losses. It revealed the limits of control. Silver did not change. Its uses did not change. Its role as a hedge against monetary excess did not change. What changed was the pressure. And under enough pressure, even the most carefully managed systems are forced to tell the truth.